Welcome to Policy on Demand. I'm Kevin Levingston. Last week, the Fitch rating agency lowered the U.S. long-term debt rating from its top mark, saying that the recent debt limit standoff had eroded confidence in the country's fiscal governance. Joining us to share his insights on this and other recent economic developments is Karl Russo. Karl, welcome.
Thanks for having me, Kevin.
Karl, in addition to the recent debt ceiling negotiations that went down to the wire, the U.S. is facing the prospect of a government shutdown if Congress cannot reach a federal spending agreement by September 30th. How did this last-minute resolution and the ongoing standoff factor into Fitch's decision to downgrade America's debt, and what could the implications of the downgrade be?
Well, Fitch mentioned a number of different reasons why they downgraded the United States debt, including the deteriorating fiscal situation. That's in the short term and also the medium term horizon. But they also did mention what they called an erosion of governance. And so it does seem like these 11th hour or later deals that have been reached on the debt ceiling and other bills have deteriorated their confidence in the ability of the United States government to manage its fiscal situation. And so that seems to be playing a part here. The markets did react. The stock market was down a little bit. Interest rates were up slightly on 10-year treasuries. But given that there wasn't a lot of new information in the Fitch report, the reaction might be muted.
So switching to interest, Karl, the Federal Reserve's most recent interest rate increase placed the borrowing costs at a 22-year high. What's the outlook for interest rates going forward?
Markets expect that the Federal Reserve is sort of done raising interest rates, at least for 2023. And actually, the expectation is that by the end of this year, or maybe in the beginning of next year, the Fed will start to lower rates. They're going to continue to monitor the situation developments, including in the labor market and the economy as a whole, to see whether or not they need to recalibrate. But right now, I think we're going to be steady as she goes for a while.
So now how about jobs, right? The U.S. economy, it continued to produce steady employment growth in July, with unemployment dropping to a near record low of 3.5%. Are we seeing any signs of cooling in the labor market as the Federal Reserve tries to stem inflation further?
Yeah, so there has been remarkable stability in the labor market. The unemployment rate has varied in a very narrow range between 3.4 and 3.7% since March of 2022. And that relative strength in the labor market has been one of the real bright spots in the U.S. economy. However, the latest job report showed us that only 187,000 new jobs or so, and the previous 2 months were revised downward by about 50,000. So we are seeing a little bit of cooling in the job market, and that latest number was fewer than the 312,000 jobs that we had been averaging over the prior year. However, it's still roughly in line with the average job growth per month during the last recovery. So it's still a relatively strong labor market as we look forward.
So a big picture, the U.S. economy seems to be capable of making it through rapidly changing conditions and higher interest rates, allowing inflation to cool gradually without a significant jump in unemployment. A soft economic landing is by no means guaranteed, but are key factors indicating that it might be likely?
So the way that some have talked about the way we'd see a soft landing would be for the Federal Reserve's higher interest rates to take some of the excess demand for labor out of the system. And in fact, we peaked at more than 2 job openings for every unemployed person back in March of 2022. The most recent data as of June show that we're now at 1.6. So that's a story that's consistent with that excess labor demand coming out of the system. So if you're going to tell a story of a soft landing, that would be the one you'd like to see. However, it does appear that there's a lot of risk still that we will stall out in the economy. And in fact, many forecasters are expecting that we'll be at zero growth by the fourth quarter of this year, and maybe GDP for the whole year will be around 1.3% or lower. And so I think there is certainly, as you said, no certainty that we've got a soft landing ahead, and we'll just have to wait and see where the data come out.
Well, fingers crossed on that. So, thanks, Karl, for being with us here today.
Thanks for having me.
Well, in case you missed it, included in the email with this episode is the latest Week in Review with Todd Metcalf. Thank you, as always, for watching, and stay with Policy on Demand for the latest developments in Washington and around the world. Take care.